Welcome to the Deep Dive.
Great to be here.
So today we're digging into something pretty significant happening under the surface of the global economy, specifically the US Treasury bond market. Seeing some turbulence there.
Yeah, definitely some ripples.
We're using a YouTube video as our guide for this discussion. It's from the ESN channel, posted May 26, 2025. The title's roughly, "The Next Financial Crisis. Is This the Culprit Behind the U.S. Bond Crash?" Intriguing title.
It certainly grabs your attention.
Our mission really is to unpack why U.S. Treasury prices are falling, meaning yields are climbing, and, what that could mean for the rest of us, for the global financial system. Cut through the noise a bit.
Okay, sounds good. Where should we start?
Let's kick off with that yield figure. The video mentions the 30-year U.S. Treasury yield hit 5.15% last week.
Right, 5.15%. And the key thing the video points out isn't just the number itself, but the context. That level, it's apparently comparable to the period just before the 2007-2008 financial crisis.
Wow. Okay, so that definitely raises an eyebrow. A multi-year high then.
Exactly. It signals something potentially quite serious is brewing.
And just a quick reminder for everyone listening, bond prices and yields, they move in opposite directions, like a seesaw.
Precisely. So falling prices mean rising yields. This 5.15% tells us there's been significant selling of these long-term bonds.
Okay, so what's driving this sell-off? What does the video suggest are the main culprits?
Well, the video points to a couple of key factors. First up is the Federal Reserve. They recently paused their interest rate hikes.
Right, which maybe wasn't what the market was fully banking on.
Apparently not. The market seemed to expect, or at least hope for, continued easing, continued cuts, perhaps. So this pause, it's interpreted as, okay, maybe higher rates are sticking around for longer than we thought.
Which makes older bonds, the ones with lower rates, less attractive. Right?
Exactly. Less attractive compared to potentially newer bonds with higher yields. That puts pressure on the old ones.
Okay, that makes sense. What else? The video also mentioned a tax cut plan.
Yes, the Chew plan. Roughly Big America associated with Trump. It's passed the House, now moving to the Senate.
And this relates to bonds because
it involves pretty substantial tax cuts for individuals, for corporations.
Okay. Tax cuts are generally popular, but what's the angle here?
Well, the video includes some analysis suggesting the benefits aren't, let's say, evenly spread. Their chart indicated that higher income earners seem to get the biggest boost in after-tax income.
And the video apparently labels this tax cuts for the rich.
That's the term used, yeah. And the concern connects directly to the U.S. national debt.
Ah, okay. The fiscal impact.
Precisely. Projections mentioned in the video suggest these cuts could add, well, something like $4 trillion to the U.S. debt over 10 years.
$4 trillion, that's a lot.
It is. There's talk of maybe $1 trillion in spending cuts too, but the video notes those are timed for after the current Trump term.
So the debt goes up now, basically.
That's the immediate pressure, yes. It's like the video uses an analogy, someone spending more while earning less, not sustainable long-term.
And that naturally leads to worries about creditworthiness.
Exactly. The video even floats the possibility of a U.S. credit rating downgrade down the line if the debt keeps ballooning like this.
Which would make borrowing even more expensive for the U.S. government.
Right. Investors might demand higher yields to compensate for that perceived extra risk, pushing yields up, prices down.
And you add that to the Fed, keeping rates higher, maybe some inflation worries from trade stuff. It sounds like a tricky mix.
A potentially dangerous cocktail, as the video seems to imply. Higher rates, rising debt, maybe inflation. Plus, higher Treasury yields mean higher borrowing costs across the whole economy. That can really slow things down.
Okay, so that's the U.S. picture. But the video also stresses this isn't just a U.S. story, is it?
No, absolutely not. And this is quite revealing. The video shows a clear trend since early April 2025. Long-term government bond yields are rising in other major developed economies, too.
Like where?
They specifically show charts for the UK, Germany, and Japan. Their 30-year yields are also climbing, alongside the U.S.
Oh, so it's a global phenomenon. Why would that be? Is it just contagion from the U.S.?
It could be partly that, but the video suggests maybe a broader concern, perhaps worries that U.S. fiscal issues, maybe trade tensions, could spill over and affect the financial stability, the repayment ability of other nations, too.
Interesting. And Japan seems to be a particular focus point in the video.
Very much so. Japan's situation is highlighted as quite dramatic. Their 30-year government bond yield shot up past 3% recently, a historic high for them.
3% might not sound huge to us, but for Japan, that's a big deal.
It's a massive deal, especially the speed. The video says it jumped over 100 basis points. That's a full percentage point in just 45 days.
Wow.
And their 40-year bond yield is also climbing past its pre-financial crisis peak, hitting over 3.5%.
So clearly a major sell-off of Japanese government bonds, JGBs.
Unmistakably. Prices are falling sharply there.
Now, here's where it gets really interconnected, right? The video suggests this Japanese bond market situation might actually be a key driver behind the US Treasury sell-off.
Yes, that's the core argument presented. It's quite compelling when you look at who holds U.S. debt. The video points out a shift. Japan is now the largest foreign holder of U.S. Treasuries. They've overtaken China.
Okay, and the UK is third, you said.
UK is up there in third, yes. So think about it. Japan and the UK are seeing their own bond yields spike.
Meaning they might need cash or need to support their own markets.
Plausibly, yes. They might need to sell some of their foreign assets, including U.S. Treasuries, maybe to stabilize their own bond markets or manage their currency.
So if Japan and the UK start selling U.S. Treasuries,
that increases the supply of U.S. Treasuries on the market. More supply, same demand. Prices fall, yields rise. It fits the picture.
that is a fascinating connection. It's not just about U.S. domestic policy then.
It seems deeply interconnected globally. And then there's another layer, the yen carry trade.
Right, the video mentioned that. Can you break down what that is quickly?
Sure. For years, interest rates in Japan were incredibly low, near zero. So investors could borrow Japanese yen very cheaply
Okay.
and then use that borrowed yen to buy assets in other countries, U.S. bonds, stocks, whatever, that offered a higher return. Pocket the difference. That's the carry trade.
Makes sense. Borrow cheap, invest for higher returns. But why is it unwinding now?
Because Japanese interest rates, signaled by those rising bond yields we just discussed, are going up.
So borrowing yen isn't so cheap anymore.
Exactly. The whole premise of the carry trade starts to weaken. It gets more expensive to hold those positions.
But what happens then? People have to sell the assets they bought?
That's the risk. If investors have to unwind these carry trades, they need to sell the assets they bought, maybe U.S. stocks, maybe U.S. bonds, to get the dollars or euros or whatever, convert them back to yen, and repay their loans.
Which could mean selling pressure on, well, potentially lots of different markets.
Precisely. It shows how instability in, say, the Japanese bond market isn't isolated. It can ripple outwards through these mechanisms, potentially hitting equity markets too.
And Japan's own central bank, the Bank of Japan, they're shifting policy too, right? They're actually hiking rates now.
Yes, that's another crucial piece. Japan is officially in a rate hiking cycle after decades of the opposite. That's going to keep upward pressure on their rates.
And they're buying fewer of their own bonds now too.
Right. The Bank of Japan is reducing its bond purchases. It's quantitative easing. Less buying from the central bank means less demand for JGBs.
Which again pushes prices down and yields up.
Correct. And this creates a dilemma for Japan. If they step in to buy more JGBs to try and control the yield rise, where does that money come from? Do they have less capacity to buy foreign bonds like U.S. Treasuries?
Adding yet another potential source of pressure on U.S. yields. It really is all connected.
It seems very tightly linked.
The video also made a comparison in Japan between bonds and stocks.
Yeah, an interesting point. It noted that shareholder return in the Japanese stock market, dividends plus buybacks, is running around 4%.
Okay.
But now, long-term, relatively safe Japanese government bonds are yielding over 3% and potentially rising further.
So a gap is narrowing. Bonds are looking more attractive relative to stocks, especially given the lower risk.
That's the implication. You might see investors in Japan shifting some money from the stock market towards the bond market as yields become more competitive, which, of course, could put pressure on Japanese equities.
Okay, so let's try and pull these threads together. We have potential U.S. fiscal issues, rising debt.
Yep, driven by those proposed tax cuts.
Combined with a global trend of rising bond yields, especially sharp rises in Japan and the UK, who happen to be major holders of U.S. debt.
Right, potentially leading them to sell U.S. Treasuries.
And layered on top of that, the unwinding of the yen carry trade as Japanese rates rise, which could force selling across global markets.
That sums it up pretty well. It paints a picture of a rather fragile global financial environment.
The video seems to suggest this is a brewing storm.
It certainly frames it as a confluence of worrying factors. The key thing to watch, according to the video, is whether those long-term Japanese government bond yields stabilize,
If they keep rising.
if they keep rising, and US Treasury yields continue to feel that upward pressure. The video suggests we could see a stock market correction.
Right.
Maybe not a full-blown crash like '08, but potentially a significant dip.
Because higher borrowing costs eventually bite into company profits and economic growth.
Exactly. The bond market often leads the way. Its influence goes far beyond just fixed income.
So wrapping up this deep dive based on the video, it's a complex interplay.
Yeah.
U.S. policy, global bond trends, Japan's specific situation, they're all feeding into each other right now.
Creating a lot of uncertainty and potential volatility ahead.
Which leads us to a final thought, something for you, the listener, to consider.
Given everything we've just discussed, these shifting dynamics in global bonds and monetary policy, the sovereign debt concerns, how might this influence your own financial thinking? Maybe it's worth pondering the potential ripple effects of rising debt and interest rates on the wider economy and how you might navigate what could be some choppy waters ahead.
Definitely food for thought.